Let's move on and talk about ETFs because,
Sorry. Sam Bankman-Fried.
There we
and
go.
It should have been Sam Bankman-Fraud is what I always said.
Yeah, that's what it was. Thanks for looking that up.
Yeah, and it was FTX was the name of the company. I don't know
Yeah.
why I just totally blanked on that.
Well,
but, yeah.
I just threw it out there, and it just came to my mind, and half of it came to my mind. You had to fill in the part, but thank you for completing it. Let's talk about ETFs because they have become too complicated. Now, the first ETF, well, it was launched about 30 years ago, back in the early 90s. They were simple in design. You generally bought them because they held a set group of stocks or maybe bonds, maybe used an index and had a low fee. And it was a pretty simple thing, and it was a very popular back in the 90s. But
The problem is today,
Yeah.
so many. There are now over 4,000 ETFs that are listed on the New York Stock Exchange. And for comparison purposes, there are only 2,400 individual stocks listed on the exchange. So 1,600 more ETFs than individual stocks. And in 2024 alone, 700 new ETFs were launched, and 33 of those tracked cryptocurrencies. The assets, frankly, they ballooned in ETFs to $11 trillion, and they now account for 1/3 of money invested in long-term funds. So again, a huge surge in these ETFs.
yeah, and it's just something that, and not all that growth is organic, and some of it has come from open-end mutual funds. Actually, about the past 2 years, open-end mutual funds lost about $1.2 trillion to ETFs. There are now 1,300 active ETFs, which they actually manage a portfolio like you would get in the mutual fund before was one of the benefits. So now they're doing the indexes and stuff in the ETFs. They're doing the actively managed ETFs. And a big difference is those funds can now be sold during market hours. When open-ended mutual funds before years ago, I remember back in the 90s when I first started doing this, you had to wait till the end of the day. Like, oh my gosh, market's crashed. You got to wait till the end of the day for that net asset value. But now that it's changed, nearly half of the 1,300 active ETFs were launched just last year. So that scares me. There's so many things that scare me. I've been doing this for 40 years. There's so much out there that's scaring me investing-wise right now.
Well, and I mean, honestly, the active ETFs are probably going to be the ones that are launched going forward because how many passive ETFs can you have? You already have all the indexes accounted for.
Remember last week we did the ones for the Republican, one for the Democrats, so that was something unique.
But that was an active. That's not going to be passive. That's not an index. I mean, those are going to be, kind of...
Well, I guess that would be active
Because
as
an
well.
index passive is going to be your S&P 500, the NASDAQ, the BND, which is your bond index. The index is already accounted for.
Yeah.
Pretty much everything else that's going to be added is probably going to be active. And the biggest problem I have with ETFs, and we don't invest in ETFs, but conceptually, I have a hard time wrapping my head around it. A mutual fund makes sense to me, right? Because you have a big pot of money. People are putting their money into that mutual fund. That fund manager is then going in and buying stocks or selling stocks based off what is needed with that pot of money. With an ETF, I have a hard time, again, conceptualizing it because how do the funds get in there? And then it trades all throughout the day based off other, stocks within the ETF. I'm like, where does the money come from and then where does it go? I mean, the dynamics of an ETF to me, they kind of boggle my mind. I don't know how it ultimately works when you actually fundamentally think about it. A mutual fund makes sense. An ETF, a lot of times I'm like, how does it work?
And one thing that does happen is that you could be overpaying for an ETF because the value of the securities are less than what you actually paid for, or vice versa.
Yeah.
You could have a discount, kind of like the old closed-end mutual funds they used to have. So it is a strange situation that it causes problems, and I
because
shocked on
the
this.
issue is, again, you're buying something that is moving second to second, so that's going to be operated based off of the supply and demand of that ETF. But as you said, it's based off the securities that are within that ETF that are also being bought and sold throughout the day. So there could be potentially a difference, I guess, between the ETF price and the stocks within the ETF. I mean, it's a complicated thing. So I always tell people, I'm like, I don't know, ETFs kind of scare me sometimes because have they truly been tested through like a 2008, 2009 in terms of the mass amount of active ETFs? The passive ones made it through the 2008, 2009 crisis, but how will the active ones do in a difficult time period? I'm not sure.
Yep.
But totally off track there. Back to what we were actually talking about.
It's important stuff. Yeah.
We talk about these active ETFs, and one of the ones that really grew to fame was Cathie Wood's ARK Innovation Fund, and really that came about in 2020 when the fund shot up 150% that year and assets hit $28 billion. Today, the NASDAQ has a 5-year cumulative return of 108%, and the ARK fund has seen a decline of 2%, and the assets are now under $7 billion. So we point this out because, again, these active ETFs, people can get sucked into the hype, sucked into the excitement, but long term, it's still a asset class that you need to be careful paying for those assets, because again, the ARK Innovation Fund, I mean, people are talking about it all the time in 2020, 2021, and then gosh, things fell apart. The big thing I always looked at is basically ARK was Tesla. It was like 15%, and that's why it did so well. But again, be careful of any ETF that you're buying. Just because it might have a lower fee doesn't mean it's a better investment.
And I think people think because they're ETFs, oh, I don't have to do the research like I would on a stock. I think you have to do so much research. Again, there's more ETFs, 4,000 of them versus 2,400 stocks. You've got to look around and really know what you're getting into. And what I don't like about ETFs is that it's like going to the store and say, well, I want, some meat and potatoes. Well, you buy the whole store because you want meat and potatoes, but you're getting other stuff you don't want there. And it's the same thing with the ETF. You look at it like, well, I don't really want those, but again, that's why I think individual investing does take some research. But ETFs, I don't think are as simple any longer. It's going to be more and more complicated, and I think it's going to be some blow-ups on that as well.
I mean, they're similar to mutual funds at the end of the day, but they're also different. So we've never been a fan of mutual funds, and I'm not a fan for ETFs is the same reason that I'm not a fan of mutual funds at the end of the day.
Right.
And because, as you said, it's a culmination of investments that you're going to like some, and you're not going to like other pieces of it.
One other thing I want to point out to people, too, is investing in commodities with ETFs. Understand that these ETFs, generally, they use future contracts to track the underlying commodity. Could be in copper, could be in silver. Now, there is one ETF, GLD, that actually does hold the gold, but most of them are using future contracts. And you got to remember, commodity futures are not a perfect vehicle, and they generally work better for speculators than they do long-term investors. Short-term investors do better with futures contracts. So one exception, again, is the SPDR gold shares, GLD. These are exceptions. But most of the time, if you think, this, and I don't know if we're talking about it today with copper, I'm going to buy some copper. I'll buy a copper ETF. You're not really holding copper. You're getting the futures, which could be in the wrong place at the wrong time. And copper could do extremely well. Like, I lost money. What happened?
Yeah.
Futures.
Yeah, I know. Contracts. It's, as you said, you're not buying the asset. You're buying a derivative of the asset or the futures contracts. It's not really the asset, which people, I think, a lot of times misinterpret.
Yeah.